Welcome to this tutorial. In this tutorial, I will be walking you through some of the aspects of working capital management. As a finance manager or as a senior accountant, your company might have saddled on you the responsibility to manage the company's finance. So working capital actually is an aspect of short-term corporate finance management. And what is working capital all about? We're going to be looking at what working capital is all about in this video. And also, we're looking at one of the aspects of working capital, which is accounts payable management. Effective working capital management serves as the lifeblood of any organization. It fosters operational efficiency and strengthens the overall stability of a company's operation. Remember, a company operation is the reason why the company is in business. If there's any disruption to the company's operation, then the company may not be able to carry out its business activities. So working capital management is very important to you as a finance management and to the company as a whole. When working capital is managed efficiently, it fosters operational efficiency and it strengthens the overall stability of the company, both in the short run and in the long run. Conversely, the mishandling of working capital can result in operational inefficiency, posing a significant risk of corporate failure if not rectified promptly. So in the short run, if a company is having maybe difficulty in cash management, receivable management, payable management, if the situation is not handled immediately or promptly, further that after a few years, the company start having a serious liquidity problem that may lead eventually to corporate failure. So you want to manage your receivable to ensure that it does not go above a particular limit. You also want to manage your payable. You also want to manage your cash, and you also want to manage your inventory so that you can remain in business. So now, what is actually working capital? Working capital, basically, they are those resources that the company needs to support its operation. The resources that the company needs to support operation. It may be in the form of cash to pay employee, maybe those that are into casual labor. It may be inventory to produce. It may be payable that you need to buy a goods on credit. It may also be that the company needs to take a short-term loan. All of these to form together the resources that the company needs to support its operation. And basically, we have four basic aspects of working capital. Four basic aspects of working capital. So here we have account payable, we have account receivable, and we also have inventory management. So four basic. You can manage your account payable very well, manage your account receivable very well, and you can manage your cash very well. Then your company is good in terms of short-term financing. Now, also, working capital is in two-fold. You are looking at two basic things when you are talking about working capital. What is the objective? Number one objective is to ensure that the company possesses adequate funds for its day-to-day operation and optimize the utilization of the company's assets in the most productive manner possible. So let me break this down a little bit. You want to get the fund for the day-to-day operation. The fund may be to buy inventory, to pay supplier, and to do some other things, right? But remember that there is a trade-off between liquidity and profitability. So as a finance manager, you don't want to tie all of your money in cash because you need money. You want to tie all of your money in cash. No, you don't want to do that. And at the same time, you don't want to say, okay, because the company needs enough turnover and you want to sell all of your goods on credit. No, you don't want to do that. Also, your supplier also will not allow you to buy on credit with beyond a certain limits. So, but you want to look at how do you manage all of these factors together to ensure that the company is liquid and the company is also profitable. That's the essence of working capital. You want to utilize the assets. You don't want to tie too much of cash in inventory because you don't want operation to stop. No, you want to look at what amount of money can we put into inventory to ensure optimum operation. So these are the things that you want to be looking at as a finance manager. Now, the need for working capital varies from company to company and from industry to industry. For instance, for a manufacturing concern, they may need more investments in working capital because of their cash operating cycle. While for a retail business, that may not be the case. But let's look at some of the factors that a company need to consider in the determination of working capital management. So the first factor here is the size of the business. The size of the business. A small business may just need a little amount of money to be invested in working capital, while a very big business or a big company may require more. Also, as activity increases, there will be need for a provision, for more provision as regarding working capital or for more investment in working capital. So the size of the company and the level of activity is very crucial when it comes to working capital management. The next one to be looking at is the cash operating cycle. The cash operating cycle, or the operating cycle, if you like. So what's the operating cycle? It is the period that a company can turn, for instance, inventory into cash. For a retail concern, you buy the goods, put it on the shelf. That same day, a customer can come, buy that goods, and pay for the goods. So the cash operating cycle there is short. But for a manufacturing concern, you buy the raw material first, take it to the store, produce. So it takes quite a number of time to convert that raw material into finished goods. So you must first of all produce the goods before you now talk of what selling the goods. So it takes a longer period for a manufacturing concern than for a retail business. So the cash operating cycle is one of the things that will be considered before you look at what you will need in terms of what your working capital. Also, you'll be looking at your receivable under your cash operating cycle, excuse me. We're looking at the receivable, the payable, and the inventory. How long does it take my debtor to pay? How long does it take if I sell on credit to receive cash after sale? How long does it take our company to pay suppliers? How long does it take us to convert goods or raw material into cash? Another thing you want to be looking at is inflation. Inflation, how does inflation affect your working capital need? Basically, in times of inflation, your company will need to invest more in working capital. For instance, let's assume that you are a manufacturing concern, and maybe you produce bread, for instance. Let's assume that on a daily basis, you use 10 bags of flour, and assuming that the cost of one bag is 10,000. So you'll be looking at 100,000 investments in raw material every day with regards to flour. There are other components, but just the flour component of it. Now, if the price of flour increased from 10,000 to maybe 120,000, it means that your company will need more investment in what? Working capital. If not, there will be a funding gap of 20,000 per each of the bags. So the inflation will also determine how much you are going to be spending on working capital. The next has to do with competitor or the industry you operate in. You don't want to ignore the activities of your competitors. If you operate in an industry where credit facility is given, your company also may also want to do the same, extend credit facility to customers for them to remain competitive and be in business. So the industry indices also contributes to how much you should invest in working capital. Or there are some industry that receivable may be very massive. But you as a finance manager, you also want to ensure that you control this. So competitors and the industry determines what and what you will be doing with regards to your working capital investments. Again, suppliers. This will also contribute. There are some industry where there are no spontaneous credit line. You cannot buy on credit. And if that is the case, that will increase the length of your cash operating cycle. So if you cannot buy on credit, that means that line of financing has been taken off. So now, these are some of the things that you'll be looking at. There are more, but these are some of the things that you ought to be looking at when you are making the determination of how much to invest in your operation. Your working capital is what you need for your operation to run smoothly. So now let's look at this aspect of working capital, which is called accounts payable, account payable management. But before we look at the account payable management, what is account payable actually? Initially, we talked about suppliers here. We talked about suppliers. So if a supplier has supplied a goods on credits, that credit sale is known as accounts payable. Buying today and paying on a later date is known as accounts payable. That means you have a liability. So now, how do we manage this liability and to ensure that the company has a good business relationship with suppliers? So now let's look at it. Account payable management is a crucial aspect of a company's financial operation. It involves the handling and supervision of the company's outstanding bills. So basically, as I said earlier on, account payable basically has to do with outstanding bills and payment for those bills. So outstanding bills, or you can call it invoices if you like, to suppliers. Effective account payable management ensure that a company meets its financial obligation on time. So why do you need to meet this financial obligation on time? While you say, okay, sometimes some company they will say, "Oh, we need cash. Don't pay that supplier now. Don't pay. We need the cash. We need to use that money for some other things. Don't pay now." So why do you need to pay as at when due? You need to do that so that there will be a positive relationship between your company and the vendor. And again, depending on the agreements between you and your vendor, there are some companies that if they give you 30 days terms of trade and you fail to pay at the end of 30 days, they may decide to transfer interest charge on that facility to you, and your company will suffer that amount. Again, some may not even put that clause. If the credit limit that you have with that company is say 50 million and you have been defaulting, the finance manager in the other company may decide that, okay, what we are going to do, instead of extending that credit limit of 50 million to these guys, let's reduce it to 10 million, because it's obvious that they do not have the capacity to meet up with their payment as at when due. So this will lead to negative relationship between you and your vendor, or the vendor may even decide that we are not doing any business with them any longer. So, but you don't want that to happen. So you want to ensure that that credit line is open. So you negotiate, you pay as at when due to ensure that that relationship continue. So now looking below, we have some key aspects of accounts payable management. What are those key aspects you want to be looking at? Number one thing you want to be looking at is the workflow. The workflow talks more about the processes. Find out that when there are no processes, errors become easy to make. It's become easy to make errors. But when there are processes, the error tends to be minimal. So the first thing you want to do is to establish processes for raising POs, approvals, and making payments. So when those processes are intact, it becomes difficult maybe to overpay a vendor, or also become at times when you don't have these processes, you don't even know when an invoice has fallen due, because the invoices are not even recorded the way they should be recorded, have been issued. So now, apart from that, you also want to look at approval matrix. There are some companies that the processes become very slow because maybe a set of persons or just only one person, maybe the MD is the one that will sign PO, is the one that will sign payment voucher, is the one that will sign this and sign that. So at the end of the day, the process becomes very, very slow. So if the company is a very big company, we want to break the approval matrix that for PO, for 500,000 or 1 million below should be signed by this person or this set of people. Once it's above this, move to this. Okay, maybe when it has gotten to maybe 10 million, you can now send it to the MD. So this helps to improve the process to ensure that things are done in a timely manner. Then the internal control is a very is very important when it comes to your payable management, because they are the ones that will vet those processes. And also invoice vetting. Invoice should not just be paid, they should be vetted to ensure accuracy before payments are made. Now let's look at some of the other aspects of accounts payable. From inception, talked about the PO. Then when the documents are being received, there are some documents that should accompany the invoice, because the invoice is what you want to pay, like the purchase order, the way bill, the receipt notes, if it's a material, or the job completion certificate, if it is a service, then the invoice. So these 4 documents are very important. And most companies at times, they just make payment. They don't even, there's no backup to the payment voucher. They just pay this, pay that. Before you know, they are running into trouble. Or before you know, they are mistakenly overpaid a vendor. So, but when you make this four-way match, it becomes very difficult to make an error. Every payment you tie to a PO, you tie to an invoice. If you are working with the software, you key them into the software. So what do you do at the point of receiving? And also, in the setting your process, there are so many things, but let me just say this, that your invoices should be properly numbered. There should be some things that should be on your invoice, at least meet some minimum requirements, like the invoice number, the invoice date, the amount in words, amounts in figure. You also want to see the signature of both the customer and the supplier. If possible, the PO number should also be on the invoice. So all of this makes it a little bit difficult for you to make error. Sometimes suppliers just give you an invoice without invoice number. And when you want to control into the system, you generate an invoice number yourself. If that invoice is duplicated, it becomes very difficult for you to be able to know that this is a duplicate invoice. But if it has a number, the system immediately flags it up that this invoice has been controlled before now. So you want to do that. So in receiving the invoice, the account department should also ensure that the four-way match is being observed. So payment to suppliers, you want to make payment based on some of the things that we have said earlier on, like your age analysis. So the account payable unit should be able to run an age analysis and make payment based on that. And also you want to do an inspection on the matches, like the four-way match. You want to verify the figures, and also you want to verify the authenticity of those transactions using the PO and every other documents before payment is made. And the audit also should be involved in the payment process. The audit unit should also validate those invoices. Then finally, for account payable module, there are other things that are being covered under account payable, but in this video, finally, this is what I want to say concerning account payable. That's all of these things that we have been saying from beginning down to this place with regards to account payable should end in something. For every unit in the accounts departments, I usually tell my colleague or people working with me that everything we are doing should end in one place, which is reporting. So every unit is supposed to be able to send in a report at the end of every month. So every unit is expected to perform what is called month-end processing. So for the account payable, what are those month-end processing or reports that they are supposed to send to management or to whoever is supervising that unit? First, you want to look at your supplier's reconciliation to ensure that balances are not overstated, because at the end of the month, you are expected to send a vendor balance to management. Number two, if there are discrepancies, you want to check between the ledgers and maybe the vendor's balance to see where the discrepancy is coming from. Investigate those discrepancies, pass journal where necessary, but those journals must be passed after seeking approval. Some of the other reports that management may need is the movement for the period. How much do we have at the beginning of the period? What are the new invoices for the period? What is the payment for the period? They'll be able to know if there is an increase in account payable balances or a reduction in account payable balances. And finally, you ought to run your age analysis reports So these are some of the things that you want to do when it comes to account payable management. So we may not be able to cover everything concerning account payable management in this video, but I just want us to look at, let's look at this short question. Okay. Now, as a finance manager, if you have this option 1 and option 2, option 1 is to buy a material XYZ from the open market. Option 2 is to use your trade credits. So let's assume that from the open market, you can buy the material for 10 million. But if you approach a vendor, the vendor has given you credit term 90 days. And this goods will cost 30 million if you are going to buy from the vendor. But if you are going to buy on cash, it's 10 million. Let's assume also that the incremental rate of borrowing, is 20%. Assume the incremental rate of borrowing is 20%. And the company still has credit facility. All right. Will you go with option 1 or option 2 on the basis of financial savings? Just on financial term alone, will you go with option 1, buy the goods for 10 million, or buy the goods for 13 million? But if you are buying the goods for 10 million, remember that you don't have the money. We're assuming that the company doesn't have the money, and the company needs to go and borrow the money from the bank to buy the goods. So should you borrow to buy the goods at 20% interest rates per annum or 13 million? Okay, we still have some other aspects of working capital management. If you are interested in learning any of those other aspects, you can inbox me, send me a message, and I will respond to that. Thank you.